So thanks for tuning in, everybody. Today I'm sitting down with Karim Nanji, CEO of Marble Financial, as well as Mike Marrandino, Executive Chairman of Marble Financial. Gentlemen, really great to have you on the show. It's your first time joining us. How are you both doing today?
Doing great, John. Thanks for having us.
Very well. Thank you, John. Looking forward to being on your program.
Karim, maybe I'll start with you. Why don't you start off by giving our viewers an overview of your company? What does Marble Financial do?
Marble Financial is a financial technology and data science company. We focus on digital financial inclusion towards personal financial fitness. We work with individuals to help improve their personal finance and wellness, including insights related to their budget, their cash flow, their spending, as well as those things that improve their credit standing. Within Canada, we have a situation where there's a lot of Canadians that are marginalized and cannot work with mainstream financial services, and they're predicated on two major issues. One is financial literacy, and the other one is in and develop a positive trade line. So we use real data to help these consumers back to financial wellness.
And I know I can just speak. Carl's not here with us today, and he was supposed to join us, but he ran into a bit of a personal situation. But I know at Follow the Money, we're really passionate about that, people achieving financial literacy. So it's great to see a company like yourself that is, aiming or endeavoring to increase the financial literacy of Canadians and help them on the path to a better financial future through more inclusion. Let's talk about the underserved population. I know in your investor deck, I think you mentioned about 12 million Canadians are sort of in that underserved market. Can you elaborate a bit on that? Who does your typical customer look like?
Our typical customer is actually, they're all everyday people. They've gone through a life event, whether it's a job loss, a death, illness, and they fell off the grid, so to speak. And it's been challenging for these individuals, especially based in Canada, when you have 50% of Canadians living paycheck to paycheck, and for every dollar of disposable income, Canadians are carrying $1.75 of debt, almost $1.75 of debt. So Canadians borrow quite a bit. We're a credit economy. So if you don't have the ability to borrow and borrow efficiently with low cost, it's a challenging environment. So these are everyday people. Our customers are nurses, they're engineers, they're firemen, they're laborers, they're teachers. And they are challenged. And over the course of the last several months, because of the current macroeconomic circumstances, it's been very challenging for people, as the banks have also tightened their guidelines in order for individuals to qualify. And so I guess the best way to answer, the people that we're dealing with are everyday people like you and me.
Mm-hmm. So you mentioned the banks have tightened their guidelines. So for example, someone that used to be not subprime, would they be now kind of bumped down to subprime because the banks have tightened their lending practices?
Well, so exactly. So you look in February of this year, an individual with a credit score of 680 could have walk into a major financial institution and qualified for a loan. That same person may not qualify for that same loan just because the thresholds have tightened. A 700 could be the threshold credit score. So it is challenging for these individuals in order to look for financing for emergencies, for home renovation loans. You look at Mike for an example. There's work going on in his house, but he was also doing renovations, and those type of decisions are now impacted because of inability to source cheap cost of credit or qualify for cheap cost of credit. One of the things that we talked about very early on was financial inclusion, and I think it's important to describe what that means. It means people and segments of the market are prohibited from accessing low-cost financial services that other mainstream individuals would be able to get. And we do this through financial technology, and we provide this through financial literacy, and then giving people the tools to be able to get back to the financial wellness so that they can go back into mainstream and purchase that home, do the home renovations loan, purchase the car, so to speak.
So Karim, out of the, say, the 12 million that you said were underserved, what approximate percentage of that, those people would sort of qualify under your current guidelines? I'm assuming that, you know, not everybody that applies is able to get help through Marble. You probably have a vetting process just like most, you know, banks or credit companies do.
So the MyMarble platform is open to everybody. It is an upmarket, it's a downmarket product. Anybody can be onboarded into the platform. Our target consumer is individuals who are typically considered as subprime borrowers. And by subprime, it means that you're below a certain risk threshold that mainstream banks are either not willing to look at, or if they are going to look at this individual, it's at a cost that is higher than what prime consumers would be dealing with. So anybody can come into our platform. We've got a freemium model that provides basic information. Financial literacy is at no cost. We want to educate everybody on what it is that impacts their financial wellness. And then we do have an upgrade option for more features and functionality. It's a SaaS-based product that provides individuals with more insights associated with their wellness. But what we help these individuals do is do those things that are going to improve their financial wellness, either on the budgeting side, but also on the credit side, where our software can give individuals prescriptive recommendations on how and what to do in order to be able to be financially included.
Okay, so I want to unpack this a bit more, because I think a lot of people have probably heard of their credit score. They might not know what it is, but they know that, you know, they do have a credit score. If you have access to credit, the credit bureaus keep a score on you. I know a lot of people aren't great at looking at that. I know personally, I watch my credit score all the time, but I know a lot of people probably don't do that. And your app is the first I've heard. I believe you're able to actually tell people specific steps that they can actually take to improve their score. And it's not just a credit report, right? It's actually, this is how you make your credit score better.
Exactly, right. So individuals can go through various sources to get the free credit score, which is a 3-digit number. That 3-digit number is what financial institutions use in order to determine creditworthiness and the level of risk. So an individual can get their credit score, but then what? Our software analyzes that credit report. Obviously, the consumer does get their credit score, but the recommendations are exactly what you mentioned right now. They're prescriptive. It's a roadmap. We provide them with a roadmap and what they need to do in order to improve that credit score. And it's a plan based on real data. It's their credit score, our software. It's AI, algorithm, mathematical based software that analyzes the specific credit report electronically and then yields recommendations very unique to that consumer at that point in time.
Okay.
So John, I
Sorry,
wanted to add just a little bit more of what Karim's added here. Because of the prescriptive nature of the platform of the MyMarble with regards to credit score, that's what makes it attractive for everyone. Because not only do it helps people that are at the lower end of the credit score improve it, but it also keeps individuals that have good credit scores remain good. And it can help all aspects of it. I compare it to, you know, financial fitness. It's like an individual wearing a Fitbit or an Apple Watch, so they can monitor their fitness level day by day to make sure they're doing what's necessary for their well-being. Well, MyMarble platform does exactly the same thing for your financial well-being, which is just as important.
Mm-hmm. That's a great analogy. I like that. And I know I've wondered before, again, because I'm one of those people that actually monitors my credit score. I do take advantage of the free credit reports that I get through my bank. And I've always wondered, if I wanted to improve it, how do I do that? And maybe, Wes, if we can bring up the the credit score. We have actually a screenshot from the app that you brought. So Karim, can you walk us through what we're seeing right now here?
Yeah, absolutely. So an individual has logged into the platform. Their simulators also in the platform. The credit report is analyzed. So we extract the credit report electronically from the credit reporting agency. In this particular case, it's showing a TransUnion score. This TransUnion score and associated elements in the credit report are put into a digestible. We've consumerized that credit report so that it makes more sense. Because otherwise, when you look at a credit report, it's very hard to ascertain what certain things mean. But in this case, we pull the credit report, the individual has gone into a component of the software, and they've got a target credit score of 700. Which you see on the far right-hand side. On the left-hand side of the screen here, you see that they've got a 610 credit score, which is poor. And this individual is not going to qualify walking to their financial institution. They may even be challenged without an alternative lender in order to get even a decent rate. So the customer has put in their target score of 700. And now what you see here on the screen here is recommendations for that individual. We show here that the individual has 90 points available today if they followed specific recommendations. These 90 points are the recommendation and the roadmap for the individual between a credit score that's pulled today and a credit report that's pulled a month from now. And the reason why we use those two goalposts there, John, is because at the end of that 30-day cycle, a lot of the credit report the creditors are reporting back to the credit reporting agencies. They're saying, for example, John made a payment on Canadian Tire, but he didn't do it on his Home Depot card, and all this information needs to come in. So what we see here is we've assessed through the software that the individual can get 90 points based on following these recommendations. And associated with those 90 points, it's going to cost $250 for this individual. What's unique about our software is this point deduction technology actually analyzes each account. So if we go down to the TDCT Visa, halfway down the page, it says if you pay $16 to that Visa, you could get 10 points. And going down the list, it says the same thing with the Hudson's Bay. Pay $100 and it could result in 28 points. And this is how we build it. So an individual doesn't necessarily, budget could be tight for these individuals. I don't have $250, but it doesn't necessarily have to be everything done in 1 month. At the end of this month, whatever payments this individual is able to make, it'll be reflected in the credit report, assuming the creditors are all reporting timely and accurately, because that is an issue in the economy. Right. And the following month, another creditor report is pulled, and we start over. And we say, okay, you've gone from 610 to 670. Now you could have 30 points available. You could have 50. You could have 100 points available, right? So it starts again. And this is how we keep the consumer engaged. We give them a roadmap, and it's very helpful for consumers who are potentially looking at qualifying for a mortgage 6 months down the road. The software is very important for them to know before they go to the financial institution, because then it's too late.
Yeah, this is great information. So in this case, you know, that person had the ability to spend $250, boost their score to 700. That could be the difference between getting approved or not approved, right? And even if they're not able, like you said, to spend the $250 this month, at least they have a roadmap. Well, you can get here eventually by doing this and that, and they can finally get in with an A lender.
Exactly. So what the point you made is very key here. It makes a difference between an approval and a decline. Mm-hmm. It also makes a difference if you are approved. It makes a difference on the terms you get.
Right.
Right. The better the credit score, the more flexible the payment terms are. Right. And so if you get approved, you may still get a high interest rate because you're approved just marginally. So it's very important. This 3-digit credit score, the higher the credit score is, the more people you have, more lenders you have willing to offer you financing, and the laws of supply and demand kick in. If there's more people willing to lend you money, you can negotiate better terms. When there's less lenders, then you don't really have as much choice because you have limited options.
Right. So, Karim, I think it's safe to say that having good credit and having a credit score is basically essential for most Canadians, right? It gives you that access to borrowing, to funds at a reasonable rate. Like, even the people that don't realize it's important, it impacts them in a serious way. Is that a fair statement?
Yeah, by definition of financial inclusion, it is absolutely critical, and it's part of the definition of financial inclusion, where inability to develop positive credit or obtain credit is by definition one of the major components of financial inclusion. Specific, and this is a global phenomenon. It happens in all geographies, in all jurisdictions. Financial exclusion is a global problem. In Canada, where we're focusing on right now, towards the end of this year, we are looking south of the border, where the opportunity is also significantly greater, just by sheer population size. But in this particular case in Canada, it does prove out Canadians are highly banked, but there's still a big portion of Canadians that are excluded from mainstream financial services. And that divide is just getting wider.
Worse. Yeah, and I know obviously the worldwide health crisis has probably just exacerbated that problem, right? In your deck, I think you listed 12 million Canadians. I'm guessing that number is now probably going to be quite a bit higher, certainly after all the government stimulus is kind of removed.
Exactly. You're going to find a lot more Canadians. The insolvencies in Canada have been increasing year over year for the last couple of decades. In this particular case, once these subsidies are eliminated, you're going to see that's the soft landing will have been removed, and you're going to see a lot more Canadians in financial hurt. At the same time, from the Marble perspective, it's created an awareness to budgeting. A lot of Canadians were caught unprepared in terms of emergency savings because in case of an emergency for unforeseen circumstances. But the problem has now resonated to the level of people are starting to pay attention to budgeting, to saving, and it created an opportunity for us to leverage the situation to be able to help more people, because people are a lot more motivated. There's a lot more high intention with respect to personal finance than there ever was before.
So just with respect to the FastTrack app that we were talking about earlier, I think you mentioned that you have a free version as well as a paid version. Are you able to get those prompts and sort of the recipe, I guess, for how to improve your score on the free version, or does that come with the paid version?
So the FastTrack app, I just want to clarify, the FastTrack is it's actually a lending product for individuals that are looking to get back into credit and financial wellness post insolvency. The Marble platform is both freemium and it's got a premium version as well, and we're working on adding additional tiers in between to be able to capture and provide services at all areas of the market. The freemium version does provide financial literacy. It does provide insights with respect to financial institutions. The individual links their bank account. We can extract that information with their consent from their bank account. We categorize it for them with respect to the budget and start giving them some insights in their spending and cash flow on that side. We do also give them basic information with respect to their credit report. On the premium version, it's obviously those insights are more on steroids. Our value element is the depth of our recommendations. From a business model perspective, we look at what differentiates us from the market. Everybody is giving a credit score. There's people providing credit building. There's people providing budgeting apps. What makes us different is the depth of our recommendations to the individual. So the higher pricing packages do provide a greater depth and more functionality with the individual. Hopefully that answers your question.
Yeah, no, absolutely. And I mean, obviously I can see the value there. I don't know what your pricing plans are monthly, but quickly, if you can improve your credit score with the app significantly, and that puts you in a better lending tier, you're getting a much better interest rate, that, the gap or the differential on the interest rate you would have got without, the help from the app versus with the, improving your score with the app will obviously more than pay for the app every month, I would suspect. And then some.
Exactly.
Yeah.
It does. It does.
Okay.
People are motivated to increase their credit score. And we've seen various degrees of credit scores. Individuals, sometimes it takes them 2 or 3 months to get 50 points, 60 points. Some individuals can get that in 1 month.
Right.
Because we're all snowflakes. There's different accounts, different stages, different lenders, and it's all based on behavioral outcomes.
Okay. I know one of your other business verticals, I believe you call it FastTrack. It's relating to, people that are within a consumer proposal. So they've got themselves in financial trouble, and your goal at Marble Financial is to try and help them get out of that. So I'd like you to unpack that a little bit for the audience. One, I think there's probably people out there that don't understand what a consumer proposal is. So maybe
Right.
that's a good place to start. And then how does FastTrack help them, get through their consumer proposal and help to restore their credit?
Right. So as I mentioned a few moments ago, the personal insolvencies in Canada has been increasing year over year for the last few decades. And then there's two types of personal insolvencies. One is a straight out bankruptcy, and the other one is a consumer proposal. The bankruptcy is ideally for individuals who don't have the ability to service an ongoing payment. So their assets, whatever they may be, are liquidated, and what's left is then divvied up between the creditors. A consumer proposal, since 2016, it's overtaken the number of bankruptcies in Canada. It's a product, both of these are obviously sponsored by the Superintendent of Bankruptcy. They're administered through licensed insolvency trustees that are for-profit businesses but are regulated through the Superintendent of Bankruptcy. And they work, it's a legal process where an individual works with the trustee and they settle. The trustee makes a proposal to the creditors as well as to the Superintendent of Bankruptcy. And what happens is an individual is allowed to settle, if approved, up to $250,000 of their unsecured debt. So if you have a house with a mortgage, it's exempt. If you have a car with a loan, it's exempt. But everything else that's unsecured ends up getting settled. And on average, it gets settled for 33, 35 cents on the dollar. Okay. So for the sake of argument, assume it's $30,000 of unsecured debt. The trustee assesses it and realizes that you're insolvent, you can't make your payments. It's settled for $10,000. And then on average, this $10,000 payment is made to the trustee on a monthly basis for 60 months at zero interest. The trustee takes a portion of that payment and then on a pro rata basis submits the rest of it to the creditors on the pro rata basis over 60 months. And at the end of the 60 months, the consumer proposal, as long as the consumer makes their payment, it's eliminated, except on the credit report, the record of that consumer proposal stays on your credit report for 3 years. On top of that, the payments that you've been making for the first 60 months don't get reported to the credit reporting agency. And so imagine for 5 years, 60 months, you're making payments and your credit is not improving. This individual who has gone into the consumer proposal, has settled their debts for 35 cents on the dollar, comes out on the other side and realizes they're still marginalized. No lender is going to lend to an individual that's active insolvent, unsecured. As soon as, in fact, most lenders, when they see an individual, I shouldn't say no lender, there are high subprime auto loans that the individual can qualify for, but they're just getting back into that negative spiral. Now, what Marble does is we find these qualified applicants, everyday people. They obviously have the ability to service the payment. The reason why creditors like it, because they get a chance to recover a lot more of their money, although it's over time. So Marble finds these qualified applicants. They're highly motivated. We generally source them after they're about a year into their consumer proposal, because we want to make sure they've got into good repayment habits and behavior. We retire the consumer proposal directly with the trustee. So we do direct pay directly to the trustee, and we take on that obligation. We do charge interest, and we do report to the credit reporting agencies. But as soon as we pay off the trustee, within the next 30 to 60 days, basically in the next reporting cycle, the consumer proposal is discharged from the credit report. And so you see a 30 to 70 point increase relatively automatically. And then the credit rebuilding starts as the consumer is making their payments ongoing. So why is that important? One, the clock start, you know, the 3 years that I just mentioned, that clock on that 3 years starts ticking as soon as we pay it out. So instead of 8 years in financial purgatory, the consumer, after 4 years, has no record of the consumer proposal on their credit report. And on top of that, they've started to rebuild their credit in the meantime. We find that our consumers pay us off between 36 to 42 months. And they typically pay us off through bank financing. They're able to walk into a bank because their credit score has improved from high 300s, low 400s to the mid 600s and higher. We have customers leaving us with very high 700 credit scores in a matter of 2 to 3 years.
So this
but even yeah, sorry, one more thing. But by discharging that consumer proposal, it does allow opportunities for that consumer, even before they paid us off, to potentially qualify for a mortgage.
Right, because they're rebuilding their credit.
Right, exactly.
Yeah. So Karim, in summary, then I think it's safe to say, so a consumer proposal, most people, it's taking 8 years. So it's taking 5 years to kind of get through the consumer proposal, pay that off. And then you're stuck in financial purgatory, as you say, for those 3 years, where, you know, you can't get a cell phone plan, for example, because nobody will touch you. You have that consumer proposal on your credit score or your credit report. So Marble is coming in, discharging that consumer proposal after only 1 year. And then that starts, you know, that countdown of 3 years at year 1 instead of year 5. So at the end, that's 4 years instead of 8 years. And the whole time that they're paying you, the client is rebuilding their credit and potentially able to qualify for, you know, products like a mortgage or a loan. That's a fair summary?
Yes, that's correct.
Okay. So let's talk about another one of your verticals, and that's Maestro. That's your financial literacy. I think that's so critical. I think financial literacy is missing in a lot of the general public, and that's not just like, I think that's missing in even people that have good paying jobs. I think it's a sort of a widespread problem. What does Maestro do? Do you charge for it? What kind of information can people get for it?
So with Marble Maestro, it is a free product. We believe that education and financial literacy is key in order to understanding. I agree with you. And we believe in that same philosophy, that the lack of education transcends any socioeconomic boundaries. Most of us are relatively, no matter how astute we are financially or sophisticated, we're all relatively unsophisticated in certain areas, especially about what it is that impacts our credit. So Marble Maestro is designed, there are curated courses that walk a consumer through specific topics related to budgeting, or what a credit score is, or topics like debt utilization and what these individual things mean. And then we provide quizzes to the individual to capture the knowledge and get an assessment of some foundational understanding associated with the customers, just getting them to a certain baseline of understanding. Then when you're reading a credit report and they're in different parts of the application, things start to make sense a little bit more. Nobody will know what credit utilization means, and people don't even know that 1/3 of your credit score is weighted very heavily on the amount of credit you're utilizing, how much of your limit. If those individuals are very maxed out, even if they're making their monthly payments on time, that's not a good thing. If it makes creditors feel that you're close to going over the edge if you're always maxed. And so it is a free product, and financial literacy and education is one of the main components, the critical components of financial inclusion.
Okay.
So, John, one other thing I'd like to add on to this with regards to Maestro, which is very key, specifically in this, in what, you know, would call the Gen Z type of individuals growing up. It's the instant gratification, the digital economy. You know, when I grew up, and I always learned from my dad, is that if you didn't have the money in your pocket, you just don't go buy it. Uh, Nowadays nobody deals in currency, everything's digital, and so very difficult for people to understand if pulling out their credit card or their debit card, and until it actually bounces and says you can't get anything, you know, they don't really understand it. So budget's not a reality, and there's more and more individuals that come out of universities and that have no idea. I know my son, give you a perfect example, came out of university, and, you know, as his last 6 months, banks were hitting him, giving him $50,000 lines of credit just because he was coming into the economy, working, and, you know, they made all this free credit. They have no idea that that has to get paid back, and what it's going to affect on their credit. So one thing Maestro really helps, not only education, but also as they come into the real economy and start earning a living and working, and helping them manage themselves financially to set themselves up for success rather than failure.
Yeah. And I think it's a key part too. I mean, a big part of your business is obviously helping people that are sort of on rocky footing get back onto solid ground, you know, rejoin the mainstream lending environment, and not be sort of, you know, relegated to the outside, or all these, you know, lenders of last resort. But I think obviously the Maestro aspect of it helps people once they've gotten back on their feet to stay there and not slide back into those old bad habits. Is that fair?
Absolutely.
Yeah. There's obviously a data side to the business. You know, the whether it's from your paid users or the free users. Can you talk about how you're building out the data side of it, and where that would play into your revenue as a company?
Yeah, so we are a data-driven company. We're giving our insights based on real data to be able to give the consumer prescriptive recommendations and insights. So data is very key. It's all predicated on the consumer consent. The consumer consents to obviously us being able to pull their credit in order to be able to have our software ingest and analyze this credit. And the consumer also gives us consent to be able to provide bank account transactional data so that we can assess. A lot of companies are starting to use technology, especially as we move closer to open banking. All this data is the property of the consumer. So it's all predicated on the data. But as these consumers are coming in, remember the premise of which MRBL exists is to help these individuals improve their financial wellness. So they've come into MRBL and the MRBL platform for assistance and help, whether it's education or it's help them with their personal finance or credit wellness. And so at a certain point in time, this consumer has been originated by MRBL through our marketing sources, whether they're through our own organic marketing or whether they've been referred to us by one of our partners in the industry. And as we help this consumer, a lot of times this consumer has come to us because they've had a negative experience. They've either been declined at the point of sale. They've either been declined for a mortgage or rent or a job, insurance, all the things that you had mentioned. So at a certain point in time, once they've come into my MRBL, they still want to buy the house. They still want that car. And once we've helped them, this data, well, one, the consumer can go out there and apply for the mortgage again, or through the data, we can start bringing some of these partners closer to the consumer. So now that we've got data on the consumer on the platform, it allows us to be able to bring additional partners in the ecosystem in order to benefit the consumer. Maybe they want a car loan. We can approach, it gives us the opportunity to have car loan companies in our orbit closer because they're looking for business and they're looking for the right consumer. We could provide this information with the consumer's consent and help them pre-qualify for that car loan or the mortgage. So again, it's the consumer's data, and we use this data to be able to add value to the consumer. And then the background of all of this, John, is we want to bring that consumer back into the mainstream economy, but bringing the power back to the consumer. That's how we leverage the data.
And part of like the My Marble app, I'm assuming will sort of give the consumer guidance on whether they're ready to purchase a car again, or say, or you should wait. Does the app kind of give
That
you
is the
that
goal.
sort of feedback? Yeah.
Yeah, so that is the goal. Like when we're talking about budget and we're talking about financial literacy and or credit score, the whole goal of all this is to provide them criteria. Just giving a credit score without showing them what success looks like is meaningless. So we want to help them get to that point where the customer is aware. Like, so as we're teaching them, they're learning that credit score is important. The target's credit score, you could walk into a bank, or you can, I mean, you can go and apply for a mortgage, thinking you're going to get a 2%, you end up with a 5%. You still want to buy the house, you take the 5%. Sure, go ahead and take the 5%. But with our software, we're also finding partners looking at this as how we can work with partners to help graduate the customer. As their credit score starts increasing, they can qualify for a lower rate mortgage over time. They can still get into the house, but there's different ways to look at it. But yeah, so as we're working with partners, and partners are starting to see the power of our technology, they're starting to understand two things. One, they don't need to decline the customer today. They can work with they can decline the customer today, or they have a plan that 30 days from now, 60 days from now, 6 months from now, the customer can qualify. So that's one angle. On the other end, it also provides the same mortgage lender. The customer has gone to, let's use any mortgage lender. The mortgage lender has declined this customer and sent them and used our software. But that mortgage lender who already has a relationship with that consumer can reacquire that customer at a future date, right? So it's not that we need to pass this consumer over to a mortgage broker of our choice. It can be their same mortgage broker in order to get them back into it. But they go in more educated. The power, it's their data. We're trying to bring the power back into the consumer's hands to be able to control. And a word right on the beginning of our deck is we want to empower them to take control over their personal finances.
Is there a potential business opportunity here, Mike? I'm going to go back to something you said earlier about, you're trying to improve somebody's financial fitness score, just like somebody who has a Fitbit or an Apple Watch, whatever it may be, tries to improve their physical fitness. You're trying to help improve their financial fitness. Is there an opportunity here to integrate your product into benefits programs that employers provide? People get benefits for their health or dental. They often get like mental health benefits now because that's important. Is there room for financial health in these benefits programs? Do you think My Marble could ever get integrated into something like that?
Go ahead, Karim.
Okay, so that's actually, we want to continue to move upstream and start working with employers. We're starting to get some traction where it's starting to resonate. Employers are seeing financial stress as a big contributor, one of the major contributors to lack of productivity at work, increased absenteeism. And when an individual is not financially well, the stress that it causes is leading to suboptimal mental wellness.
Right.
And this is becoming a big issue for the individual from the health perspective, but economically speaking, it's impacting employers, and insurance and benefits programs are getting more expensive that way. So moving up the chain and curing the problem, trying to prevent some of these things from happening up at the source is very important. And so working with employers, like right now we've talked about mortgage brokers and lenders and car dealerships and other credit rebuilding companies, but being able to work with employers and providing our software as part of their benefits program is a key strategic initiative. And we're starting to talk to technologies that are also providing benefits programs, or insurance providers that are providing this, and how this can benefit. But something else that you said with respect to personal financial fitness and the analogy that Mike used about Fitbit, imagine, and this also ties in what you said about data. As we're collecting all this data, that data is meaningful. We're talking about on the aggregate. We're learning things about consumers that other players in the industry know nothing about. Remember, we said they're marginalized. So their credit report doesn't say anything meaningful. We're collecting alternative data sources from these individuals, and we're learning a lot about these individuals. So the data science component of it helps us start to determine scoring. That scoring could be adjudication scoring for the individual qualifying for products in the future. It allows us to create indices for these individuals. Then you imagine, again, using the Fitbit analogy, the marble score, and I'm being very aspirational here, but this is the trajectory we're moving into, in every smartphone where individuals have their marble score, where it's leveraging not just financial health from the credit score, but also leveraging their financial wellness and resiliency and vulnerability with respect to their personal cash finances.
Right.
You can see this on a wearable, where individuals are saying, well, this is my marble score. We want to be able to benchmark these consumers with their peers, with demographics. And that's what the data is going to help us do. And focusing on a segment of the market that nobody else is talking to is very key for us, because that segment has now exploded. It's been magnified. It's grown considerably. And we want to help these people and empower them.
So I guess it would be very similar to how, you would benchmark, say, for physical fitness, the average person runs, this distance at this age, and obviously at a younger age, more people can run a 1K faster than they can at an older age. So you're trying to benchmark this for financial, like, to say most people your age are in this area, so you're below. So giving people that incentive to try and, hey, you need to improve your financial fitness because you're falling behind the crowd, kind of thing.
Exactly. Like, for instance, we can look at an individual in the personal health personal health fitness world. We're looking at body fat. We're looking at weight. We're looking at nutrition. How many times are you going to the gym? What does all this mean? So using the same type of analogy on the personal financial fitness side is the same thing, that you're compared to this with in relation to other people of your age, or of your province, or demographic, whichever way you want to look at it. And this is what your credit score is related to everybody else. And this is what your credit score is. Now let's look at your credit score. Why is it this way? Well, debt utilization, make this payment. You've got a collections item. If you tackle this stuff, our software can help with all this stuff. You can say, look, just retire this account. Your credit score will jump 30 points. And having this individual being able to log in every month and engage and saying, how am I doing? That's the goal. Again, there's a lot of partners, and there's parts of the industry that are very suboptimal. So we work with that happens. The way that happens is that the credit score only changes as creditors report payments and behavior, right? So you can look at your app every day and see whether your credit score has changed. It may not change until there has been some changes that have been reported to the reporting agencies.
Monthly. Right? Okay. I know you had a big transaction announced just yesterday that I want to get your thoughts on. But before we get there, maybe let's cover quickly your last two verticals that we haven't touched on, which would be CreditMeds and CreditBeacon. Can you walk us through quickly how those integrated to MyMarble?
Yeah, so CreditBeacon is our secured credit card product. A lot of individuals that are credit challenged have a hard time getting credit, and the credit score is impacted with the type of credit you have. A mortgage loan works differently than an installment loan, which works differently than a revolving credit loan. And so our software, when we're prescribing recommendations, will recommend a secured credit card. But what happens with these individuals as they go to apply for a secured credit card, they've got to put up the cash. And so a big segment of the population, okay, great, I've been approved. Now I got to send them $500. They don't have that $500. So I can't share too much because it hasn't been announced, but there's opportunities to look at this very creatively. But at the same time, we want to be able to launch a secure credit card product that we have insight into the transactional activity in the credit card, because that's what we want to ingest into the MyMarble platform so we can give them proper insights. A lot of people use these credit cards for automated payments, so on and so forth. And so the CreditBeacon is a secure credit card product that we hope to launch in the first half of 2021. CreditMeds is a diagnostic tool that measures individuals. A lot of our consumers are applying online for credit. They don't need a new loan. They've been borrowing from Peter to pay Paul. The number of Peters have decreased, but Paul is still waiting for his money. What they need is credit relief. They need to be speaking to a professional about restructuring their finances. And so CreditMeds is it's a software, but the user is not the consumer. It's software technology that is predicated on diagnosing the consumer and matching them with the right professional to help them.
Okay, so it's almost like a matchmaking service.
Yes.
Yeah. Okay. So let's talk about the transaction. It was just announced yesterday. You're acquiring a private fintech company. Walk us through what's the reasoning for the transaction and how is it going to help Marble Financial, I guess, broaden its services or improve its services, improve revenue.
Right. So Inverite is a local Vancouver company. They've been a partner of ours over the last year. They are very similar. Well, basically, they're a financial transaction company. They've got technology where, and we've all used it, we've all seen it, where a consumer is using this technology to be able to share their financial bank account transaction history. Typically, these types of software is used for consumers looking for quick adjudication on a loan, where the lender is using this technology rather than getting a whole bunch of paper bank statements. They give consent and transactions are electronically derived with the consumer's consent. At the same time, these type of technologies are used for identity verification. These type of technologies are approved by FintTrack in developing and approving the Know Your Customer rule.
Right.
You end up proving that the customer is who they say they are. But the reason why this acquisition is very important to us is it brings us closer to the data. Inverite is a company that's already out there speaking to other lenders and aggregating data. Although there's a middleman in between, it's the technology, it's the lender, and then it's the consumer. But the data on the aggregate level is very important to us. It's very important to us because it's telling us things about the segment of the market, and the technology is currently being launched, or it's currently being utilized in a segment of the market, which is our ideal target customer, those individuals that are marginalized. And so on one front, it accelerates our ability to diagnose and analyze this data for further insights that we can use to be able to offer insights to consumers. We talked about benchmarking, we talked about all these things, but this is on the budgeting side. At the same time, it is a revenue generating opportunity. It allows us to get into other verticals that leverage consumer data in this way in order to be able to get more insights on the consumer. On the other side of the Inverite transaction is that we are looking for insights associated with the customer's financial health in general. And we've determined that the financial health is predicated on a lot of things. It's their transactional data, how they spend, how much they make, where they spend, how they're spending, budgeting, emergency savings, all those things, coupled with the importance of credit data. And linking those two things allows us to be able to start developing algorithms and scoring about tying these things together. Remember, this consumer is off the grid. So the credit report in and of itself is meaningless because it's just a score. The score is not high enough, so we can't talk to you. But layer this on with alternative data sources, because remember what we're learning on the bank account transactions. We're seeing that this individual pays rent on the dot every month at the right time. They're paying their cell phone bills. They're paying their utility bills. We're seeing all these transactions, and we can use that to help these individuals. And then ultimately, in the background, we're obviously collecting and aggregating a data set that is meaningful in and of itself, right? Because that data it could be important to individuals and other partners that down the road may want to sell cell phones into our ecosystem, provide a package. Might be a big department store might want to offer services to these individuals, and we'd be able to help market them and get them pre-approved based on the consumer's consent. So it allows us a lot of things, but the Inverite is it's obviously integration with a partner. We bring it in-house, and we can work with Inverite to continue to build their existing roadmap, because it is an additional revenue stream for us. But we can also influence the roadmap a lot closer in order to continue to build the overall Marble strategy.
Okay. Mike, maybe I'll throw this question over to you. How will the company be financing the purchase? I think the news release said 1.5 million was the purchase price. Is that going to be issued in shares or cash or combination?
Well, we just closed a $2 million financing within the company. So between our cash on hand and we do with the financing that we offered that closed, we did 3 tranches in Q4 of 2020. There are some warrants attached to that have a conversion factor on it. So we feel with the growth of the company, with its own and the money we have on hand and exercising of some warrants, we'll have more than sufficient funds to close the first part of that transaction.
Okay.
By the end of March.
So it would be mostly cash then?
Yes, it would be mostly cash. The transaction that we did with them is $1.5 million in cash. They do have an earnout provision over the next 2 years. The ability that if they can increase their annual incremental revenue, they do have the ability to earn up to a maximum of another 2.5 million. That 2.5 million, we have the sole option to either pay for it in shares or pay for it in cash, or a combination of both.
Okay. One question I want to ask, because I think it's an important one, it's one most investors ask, is how, if I invest in your stock today, how am I going to make money? So I guess what is the goal of the company? Are you guys actively trying to, get the company to a point where you can sell it? Or are you wanting to build this out to, eventually pay shareholders dividends? How does that look?
Well, you know what? We're a company that is building a solution. We're building a solution that's going to help the consumers, as Karim kept mentioning it, get back into mainstream economy. We're the type of company that the major financial institutions, they don't play in this sector of the market. They're looking, they are regulated through the different financial institutions, and that they have to keep a certain level of credibility, and their clients have to have a certain credit standing to be able to maintain that. Our goal is to be able to develop, provide, and successfully and financially offer a solution to the consumers, where a larger entity will then acquire us as part of their growth strategy. This is a sector of the market that's continuing to grow. As you see, there's fewer and fewer people. The economy is either getting to the haves and the have-nots. The middle class is disappearing. So the haves are a very small sector of the market, where the majority of fintech companies are focusing on. Very few are focusing on the sector of the market that is the underbanked and the financially underserved. Our goal is to find a solution for those to come back into mainstream economy, come back into the middle class, come back into where the banks and the major financial institutions can acquire these customers, can offer them products. That's where we see the value proposition in Marble as we go forward.
Okay. Your answer, Mike, brought up another question I had, and I think it's an important one. What does the competitive landscape look like? I've personally never heard of a company that does everything that Marble does, but you're probably more aware. Are there competitors out there, and what kind of barrier to entry would there be for other firms to try and mimic what you're doing?
Well, I mean, I'll put it. I'll let Karim expand on it, but I'll give it to you that we're in a sector of the market, that you can get that if you look at it from a general perspective, for helping rebuild credit or financial services, there's a lot of companies that you can throw in there and say they're our competition. But from a diagnostic and from a prescriptive nature side of it, of how we actually help consumers, educate consumers with their financial well-being, very few, I would say, are in this sector of the market. And Karim, I'd like you to maybe expand more on that to help John with his answer.
Yeah. So, Mike, you did pave the way for the exact answer. Is that there's a lot of players in the market right now. A lot of them are providing very point solutions. There are lenders, there's companies that are providing credit rebuilding, whether the credit rebuilding comes through a savings loan or it comes in through a secured credit card. There's obviously a whole bunch of budgeting apps out there as well. But these are kind of disparate solutions to the overall wellness of the consumer. And the wellness of the consumer, especially because, remember, we started off this conversation by saying digital financial inclusion towards personal financial fitness, right? So that may seem like a chunk of words, but really, personal financial fitness for the segment of the market that's on the outside looking in. It's through technology that we're doing this. So it's saying a lot in those few words. And personal financial fitness and digital and financial inclusion is defined by three things. One of them is that individual doesn't have a bank account. That's by definition, but that's not a problem in Canada. It is elsewhere. 1/3 of the US population they don't have bank accounts. They're cash preferred by choice or not choice. So bank accounts is a big thing for financial inclusion in other markets, not in Canada. But the other two areas are financial literacy. People are just not educated on those things that make a difference to financial wellness, right? So there's not a big focus. The reviews and the reviews that we've got on Marble Maestro on financial literacy were overwhelming, where we need something like this to be able to educate people. And the third thing is obviously inability to develop a positive trade line. And there's a lot of factors that go into inability to develop positive credit. It's not just by your credit score, but you can't just develop a credit score automatically. The credit score is not just going to increase without you doing something. So there are big impacts and dependencies on cash flow and budget. So all this tied together is what we're doing and under the umbrella of personal financial fitness, and the segment of the market is the segment that is excluded. So there are a lot of competitors, but the competitors and point solutions.
Okay. So you have more of an integrated, holistic approach than some of the competition.
Yes, absolutely. We're not focused strictly on lending. We don't have to be the lender, although we do have a lending product. You talked about barrier to entry. Marble has been providing the FastTrack product since 2016. We have 4 or 5 years worth of data that shows that we've been very successful in helping Canadians do this. But most lenders, if not all of them, will decline this segment of the market just because they're in insolvency. And our algorithm is our barrier to entry. We have 4 or 5 years worth of data that tells us we're doing it right. So other companies can throw a whole bunch of money and take the risk on that, whereas we've learned things over the years. So expertise is a barrier to entry, absolutely.
And the key is also that's one of the key reasons we acquired Inverite. It actually provides us with so much more data rapidly to be able to, for our machine learning, our algorithm, to be able to better help the sector of the market that we're going after. It's all about, it's a huge sector of the market. Our goal is to grab as much of it as fast as we can, to become as relevant as we can, and data is the key ingredient here for us to be successful, and that's why Inverite was very strategic for us.
Okay. So when it comes to revenue projections, obviously you're not cash flow positive now, but I believe from your deck you're expecting revenues to sort of ramp up this year. This will be a big year for you, and then moving into 2022. Can you walk us through, what do you have a projection on when you might become cash flow positive? And, will you be looking to do another financing this year to raise more capital for the company, and how would that be allocated?
So uh, I'll start it off on the finance side. As a technology company, um, uh, it's all about the collection of data. Revenue, revenue is helpful, but becoming profitable as soon as you can is not the top priority for us. For us, it's acquiring data and acquiring users, and keeping those users on our platform, and learning more about them, and helping them, that the growth side of the company first and foremost is from a user acquisition, and on our platform. Secondary would be definitely, we do have an obligation to our shareholders and to generate revenue, and to become a profitable entity. We feel that this year we will be entering into another financing probably in Q2 of this year, as our growth continues, as we continue to develop, as more products come to the market, as our MyMarble platform becomes a bigger and more holistic entity for helping this sector of the market with it. So I think hand in hand with the financing and with our user growth, we anticipate in the latter half of 2021 to be able to turn the corner and become cash flow positive, and start and becoming a profitable entity going forward.
Okay. I know there was mention before, Mike. I'm reading back in some of your news releases, you were looking at converting some of your existing bondholders in the Phoenix Fund to convert that to convertible notes. Is that still in the works?
Yes, it is. As a company, when in our earlier days, it was a fairly simple revenue model. We would issue bonds at 8, 9, and 10%. And with our FastTrack product, we lent it out at between 18.99 and 23.99, depending on the individual. And then there was an admin fee on top of that. So and the delta in between is what paid the bills for us, and what generated revenue for us, and that was always kind of break even, slightly positive for us in going forward. But bonds are very an inefficient use of capital, specifically when you have a loan portfolio. So we had the loan portfolio on the asset side, and we have the bonds on the debt side to match each other out, and continue moving the company forward. In trying to make the company more cost effective in reducing our expenses, we wanted to move the bonds from a subsidiary of ours into being an obligation to the parent company, as well as we wanted the flexibility of converting that debt into equity at a higher valuation of the company, which would reduce our debt obligations, but also it would allow us to then utilize the instrument in creating revenue for the company, and also bringing in more sophisticated investors, institutional investors within the company for growing our loan portfolio.
Okay. So the company IPO'd, I believe, in spring of 2019. So you've been public for, I guess, about 2 years.
Yep.
Up until December, I think it's fair to say the trajectory was kind of downwards for the most part. Things are starting to turn around. The price is starting to move in the right direction. Can you maybe quickly walk us through what's been the challenge when it comes to the Marble story about, passing that on to investors, and what are you doing to help get the word out to improve the share price?
Well, being on your broadcast right here is a
Yeah.
perfect example of what we're trying to do to help people understand our story and broaden our horizons. The story is Marble is and its story and its business has been a challenging one in getting people to understand our value proposition, understand how we make money, and we always went forward on this on a social responsible way. Why I got involved with the company and why I fell in love and became the largest shareholder is because I have an opportunity to give something back. And Marble, and when I got involved with it, I that's what really attracted me to it, is how it helped individuals. The comments that we get back from people that we've helped rebuild their credit, get back into mainstream economy, is heartwarming. It really is. That aspect of being able to help people, educate people, was the driving force for Marble. Now, going forward, as he went public, that was an arena that I have more experience in raising capital, and then from there bringing on Karim and his team that has the expertise in the operational side of it. So it was a great fit, a great marriage, in Karim building his team, in helping operate, and my experience more in the public market in trying to communicate out to the investor what we're all about. But it's a story that is simple but complicated. I think everybody understands credit, but nobody knows what it means.
Yeah.
Out of the every time I ever talk to an investor, said, "When's the last time you checked your credit score? Or do you know what your credit score is?" 9 out of 10 people didn't know what their credit score was.
Mm-hmm.
Nobody needs it. Nobody even thinks about it until they go out and ask for credit. And when they've asked for credit, they get turned down. They're thinking, why? Why did I get turned down?
Mm-hmm.
So it's kind of too late by then. So one of the acronyms that our marketing teams come up with is "Know Before You Go," and it's all about knowing about your financial well-being. Knowing, you go to the doctor, get checked up, to know how you're doing, and you've got these fitness wearables to know how you're doing. Well, your financial fitness is just as important. So it's simplifying the story. It's touching the right buzzwords and the right aspects for individual to get. I think what's transpired over the last year in this world health crisis, that has made people a lot aware. People have lost jobs. People have all of a sudden had to change their whole lifestyle and how they operated, how they worked, how they dealt with the economy. It's made that a lot more aware. All of a sudden saying, now I get what Marble's about. Now I understand what you're doing. And I think it's starting to resonate, as you see in our share appreciation.
Yeah. And Mike, I've just certainly noticed you've been very active buyer in the market. I would say a pervasive buyer in the market yourself, and I believe one of your directors, Jason. So I mean, it obviously shows that you believe in, and it's really good to hear that you're getting that sort of feedback from your customers. I'm assuming that, yeah, that would feel really good. So let's
Yeah.
maybe one last question for you guys. It's been a great interview. we're starting, it's now the start of a new year. 2020 was a very challenging year for, I think, everybody. What are you most looking forward to in 2021 from the Marble perspective? I'll start with you, maybe Mike, and we can end with Karim.
Sure. What I'm looking forward to is really broadening our investor base, having an opportunity for people to listen and understand our story, and really get the value proposition. There's making money is great. You have to do a return, but the social responsibility of what we're doing in conjunction with helping individuals is the more I can get the story out, the more I can make investors aware of what we're doing, and how people can be part of this new economy, being part of helping these individuals, and on the other side, make some money along the way. That's what my goal is.
Okay. And Karim, what are you most looking forward to in 2021?
Well, just the first comment is just in terms of alignment between what I'm looking forward to and what Mike said, is that in October of last year, Forbes came out with some research on an article that the next $1 trillion opportunity was in fintech, was the underbanked. And so continuing to learn from Mike, but as well as what Mike said about increasing or augmenting our investor base and make it more diverse. This is an opportunity for those individuals that sat on the sidelines and felt that they missed out on crypto and missed out on cannabis. Don't miss out. This is a gateway to a $1 trillion opportunity in fintech. With respect to the business of the business, we're looking forward to developing additional partnerships. Over the course of the last several months, we've increased our relevancy in the market, and we've seen a lot more partners looking to partner with Marble, continuing our product development, bringing more product solutions, increasing our user base, and towards the end of the year, looking for further expansion opportunities south of the border.
Okay. Well, gentlemen, this has been a great interview. It's been a very interesting company. I think it's an interesting business model. I can definitely see the opportunity here, and it'll be great to follow the story and just see how you guys can execute on 2021 to continue to build this. So thanks for
Thanks for having us.
appreciate the time, and thanks for joining us.